Well, fantastic. Thank you, Marty. That was hands down great presentation by Julian. Looking forward to picking up on those tailwinds and leading into Axel's little discussion on gold and Tyson's about how he views the market. And we also have with us Sid Jain, who is with Money Mall USA Corporation, a fixed income strategy. So we're going to be interested in talking with him about how all these different strategies play. So looking forward to this conversation, and welcome to all. And out in San Francisco, glad to be joining you today. We're going to talk about a bunch of topics related to alpha strategy, alpha alternative strategies, just so we're clear on the definition. Outperforms the benchmark by a significant amount, usually actively managed, identifies market inefficiencies that allow for the alpha, and whose lifespan is usually limited. So timing can be very important on these things. My name is Mark Heil. I've been involved in alternatives since the mid-90s. In marketing, capital raising, fund administration. Currently, I'm working as managing director with Pickwick Capital Partners, boutique investment firm. All right. So that's Marty talking in the background. Okay, got it. We are FINRA registered advisors to middle market companies and alternative asset funds providing strategical and transactional services. To be clear, our panel discussion is for educational purposes and not to be considered tax, legal, or financial advice. To the extent that I offer an opinion or any of our panelists do, it's our opinion alone and not necessarily of our employers or our companies. For the next hour or so, the panel and I are going to have a discussion about alternative asset strategies. You're invited to participate at any time. You don't have to wait for the end. Real time is great. Love the interactivity. I would remind you not to be like the Honorable Edward Everett, who spoke for close to 2 hours prior to Abraham Lincoln's Gettysburg Address. So nobody remembers a word of what he said, but everybody has Lincoln's Gettysburg Address memorized. So try to keep your questions short and to the point. That's the point of my raising that. With that, I'd like to introduce our panelists. And Axel, I'm going to start with you. Just give us a few on your background and Merk Investments. Tell us a little bit about that. And then a little bit later, we'll go into the gold and the gold strategies that you promote.
Thank you, Mark, and welcome everybody. Yes, I'll stay brief for now, and then we can expand later. We as my family and my business involved in alpha strategies for many years. The point of me being here today is our work on the gold and gold mining side. We manage 1.5 billion in that space. We have a physical gold ETF. We have a closed-end mining fund that in particular invests in junior mining companies. And to just frame the discussion that we'll be having later on, part of the reason why people are looking for alpha strategies is that when they're concerned about equity markets, they're looking for diversification, and there are a few ways of doing that. Gold historically is an asset that is not correlated to equities. That said, it doesn't mean it's always has a correlation of zero. It morphs in and out. Gold miners, many people are not aware of, have a very different risk profile. The price of gold, for example, has historically a volatility similar to that of equities. Gold miners can have significantly more, especially on a junior space. It can easily be twice as high for a diversified portfolio even. And what you're getting is you're getting the potential for extraordinary returns, partly because of the volatility, but also because active management is really something that's gone out of fashion with the rise of ETFs. And there's a lot of value that can be added in a space where you have depleting resources all the time. And then when you help finance, as we do, these smaller mining companies, as they get institutionalized, when they're added to indices so ETFs can buy, there are some unique opportunities there. So I'll just leave it at that, and then we can go into more detail as to the dynamics there and the alpha component.
Well done, and thank you for that. Tyson, would you take a few minutes to go through your background and history, and then we'll a little bit later, we'll dive into your thoughts on the current state of the market and best ways for people to navigate it.
Sure, Mark. My name's Tyson Halsey. I am the managing member of Income Growth Advisors. We are a registered investment advisor in Charleston, South Carolina. I've been investing in the market since I'd say 1984, so 40 years. And I have a startup called Optima Process Systems, and we look at energy transition technologies. And what's interesting about that is it's given me a lot of insight into the private markets and opportunities in venture capital and private equity. That's it.
Beautiful. Thank you. And I'll tell you, Tyson's being quite modest. Yeah, if you look at his LinkedIn profile or you look at other things, you will see he's done a lot of incredible things. Sid, if you would do us the favor, I don't know if you could turn on your camera yet. I let Marty know that you're having some difficulties. But if you could give a few words about your background and about Moneymall USA, I'd be appreciative.
Sure. So
there we go. Now your camera's on. Great.
Yes, yes. Well, the background you see, it reflects our state of mind for alternative investments that we offer to our clients in the alternative assets category, primarily real estate. So we've been in business for 35 years, out of which 25 have exclusively been in real estate. I have a couple of master's degrees. I've attended PhD programs. I've attended Harvard Business School, Harvard Law School, and most recently, I completed a course at MIT on AI and machine learning. So that gave me a good view from 50,000 feet into what AI can and cannot do for companies and the economy. And the previous speaker touched on that a little bit, most of which rang true. So alternative assets are the way to go for a certain portion of your portfolio. Not all of it, but it can definitely contribute to a worry-free, stress-free lifestyle.
Fantastic. Thank you. All right, Axel, we're going to kick off with you, and we're going to talk about gold more deeply. And tell us why you're so bullish on gold, and why people should have it in their portfolio, and how much of it should it consume.
Worry-free and stress-free lifestyle. If you're an investor in gold, that's not a good idea to mix the two, because whenever the price of gold is doing well, there's usually something else that stresses you. So you're always just halfway happy. To address your question here, as I indicated, right, the price of gold has a near zero correlation. Gold just is, and gold doesn't change. It's not productive. It's this barbaric relic that people always wonder why they should have it for the future. But most people are somewhat glad why they had it in the past. And we are, to just tie into the previous presentation here a little bit, in an environment where it appears that major global factors are changing, and to just go kind of against that worry-free lifestyle, to look at some of the one of the things that historically gets the price of gold higher is global instability. In my view, that's usually, historically at least, not a good reason to buy gold, because the market gets used to crisis. What's changed, in my view, is that the peaceful environment we've had since World War II might be coming to an end, and what we're seeing in terms of crises might just be symptoms of an era to come. So the crisis buyer is a gold buyer. The buyer who buys gold because they're concerned about the purchasing power of the dollar tends to be around. And we have two parties in the US. The Wall Street Journal just had an article yesterday as to that fiscal sustainability is not a topic in this election. And people shrug it on the table. Indeed, I sometimes think we are almost like in Mexico, where each candidate is making as many promises as possible. And so there's an expectation that we're not going to get our fiscal house in order. We have the diversification buyer in the price of gold. I alluded to that earlier. And then we got the speculator. The speculator hasn't been quite active in the space. They've been more involved with meme stocks and other things. I have no doubt that they can come back. And so in many ways, gold is the one hedge you can have against, I think I've been quoted as the mania against what our policymakers are up to. And so as far as the amount, I'm not allowed to give a specific advice. I have significantly more gold than many others have. I recently published a newsletter in which I said I have several thousand ounces in the gold ETF that we manage. And so you can do the math, but that's not a negligible amount. It's really with any investments is how much can you afford to have? I see investment allocation much more as risk management. And the one thing investors should be aware of course, is that while I mentioned the price of gold has a volatility of that of equities, that can spike. So you bear the volatility, and especially if you go to gold mining, which is really on the speculative side, can you afford the downturn? So I might be bullish, but it's really, can you afford it to be wrong? And before I hand it over, with anything I say, it's not so much whether I'm right or wrong in any of my crystal ball here. It's whether people think that there's a risk that I might be right. And so with anything you hear from anybody, it's more of a risk assessment. Are these scenarios plausible? And if so, what does my investment allocation look like if those scenarios unfold? I'll pause here.
Well, I'm going to ask you a follow-up question or two, if you don't mind. So when you think about gold and owning gold, are you talking about the gold bar itself, or are you talking about, you mentioned you have an ETF and that owns gold. You mentioned about owning stocks of gold. So you're talking about having it in your current currency and owning it through a currency.
Yes, so I own both physical gold, physical through an exchange traded product, and then obviously also we invest in gold mining, where you buy gold in the ground, and their values in any one of them. I'm not a big fan in quote unquote hedging gold in a specific currency. That's kind of a different way of looking at things. But the big difference between the physical gold and having gold through an exchange traded product is you tend to be less inclined to trade it if it's physical, because it's more cumbersome, right? When you have an exchange traded product, you push a button, you can buy and sell, and there are of course a whole range of different products about it. I for regulatory purposes I can't talk about ours here too much, but ultimately, what I promote is a long-term holding of gold, and of course, the physical coin works as much as anything else. The challenge really with the coins is it's fine if you have a coin, but what about if you have several coins, right? We talked about the guns before. Then you need to buy the gun because it could be stolen. The gold doesn't have counterparty risk, but the moment you touch it, you introduce it, if only because you could lose it, and then you store it. But then people get worried about where do you store it? So it's for as simple as gold is, it creates all kinds of interesting questions.
Sure. For the foreseeable, obviously, I think based on Julian's presentation this morning and what you've said so far, it sounds like gold should be a mainstay in your portfolio for a while. But when you begin, what will be the signs when you should begin to think about liquidating it or getting out of gold? What will be the things that an investor should be looking for at that point in time?
So I started buying gold in 2004, I believe, maybe a tad earlier than that. I think people should sell their gold when our politicians come to their senses. That's the short answer. So if you
you're never going to let go of it, is what you're saying.
Well, the other way to say that, right? We saw the Eurozone debt crisis, and that gave us an idea of the amazing ability of policymakers to kick the can down the road. The one thing we have a big disagreement with a lot of the gold community is that a lot of folks and a lot of the gold bucks say, oh, there's going to be this great reset. And we don't agree on anything. International politicians don't agree on anything. We've been going further and further away from a gold standard. You can only have a gold standard if you have fiscal discipline. Where on earth should that be coming from? And so I tell people, well, have your own personal gold standard, right? I mean, you're still going to get whacked. That's a technical term with taxes when you realize any gain, but it's as long. And Paul Volcker, aside from being known for being a hawk on inflation, he said that in order to have stability, you need, he called them the three verities. You need stability on the monetary side, so no inflation. You need sustainable fiscal policy, and then you need stable institutions. And if you take the US, which I believe is better situated than many other countries, all those three areas have been eroding. So if you see these things improve, then of course, yes, you can start thinking, well, should I be trimming things back? And of course, in the short term, just on the trading side, clearly what the Federal Reserve says that they might do, and I say what they say they might do because the expectations matter more than what they actually do. So if they say we're super tough on inflation, that is a headwind to the price of gold. So in the short term, it can be that yes, if the Federal Reserve is again in an environment, inflation is high and we're going to do something about it, that might be a headwind to it. And that said, the price of gold did quite okay in that environment, right? The bigger competition appears to have been the stock market goes through the roof in a zero rate environment. And so that's why I also encourage people to be long-term investors in most of what they do, not just in gold.
Yeah, and you mentioned a little bit earlier about speculators. Yeah, you're not seeing them jump in, and I would probably say, they probably jumped back into the gold market in 2017, 2018 time period, and drove it up and have been holding since then. I don't know if that fits with your thinking as well.
Well, I mean, I mentioned a few times, we mentioned that we manage a closed-end fund in the gold mining space, and there in the gold mining side, you really see the speculators much, much more, because when you have gold in the ground, you're literally buying an option on them finding gold. And so in a favorable environment, when this quote unquote option gets into the money, you can have these amazing returns. Now, some of these folks go out of business, of course, because they need to have periodic funding to develop the mines and whatnot. So I'm not saying everybody should pile the money into it, but that's where we can see the speculative aspects of it. When you see mergers that are very expensive and whatnot, instead what we see is a lot of discipline in that space. And also on the retail side, on the physical gold buying, it's been fairly modest. Now, part of it might be the competition from digital assets and whatnot, but ultimately they have different risk profiles, these different choices. And so I think there will be, at some point, there will be a speculative frenzy, and I don't think we're there yet. And so, of course, yes, if you want to trade, that might be a time to pull back.
Hey, Mark, I have a question. I just want to jump in for 1 second. So Axel, for years, people have said that, paper gold sometimes is used to suppress, gold pricing. If that was the case, do you think that there was capitulation, like Julian was talking about earlier, that some of that suppression would go away as well, or?
I think we need to have a GoFundMe page for all gold bugs, because they always believe in conspiracy theories. We have paper markets in every market, right? And I think to illustrate kind of the quote unquote manipulation and whatnot, a few years ago, we had these negative prices on oil futures. And it wasn't a conspiracy theory, it's the small print, right? It's the small print that matters. And so the folks who talk mostly about manipulation in these spaces, I think they just don't understand how these markets work. Of course, there's hedging, and of course it impacts the price, and you can call it a manipulation or conspiracy. It's just part of what all these markets have, and there's a value in these derivatives markets. And if you don't want to be in them, then take it out from the paper market and take it to the physical market. But one of the things people don't understand is people say, oh, what about if in London the gold is not available? What's going to happen if for the gold exchange set of products? Well, the price of gold that's quoted typically is the price of gold in London of a London bar. And so that price will reflect it. If there's no bar available, yes, it's going to go through the roof. But it's obviously, if you look at the price of gold somewhere else in the world, which you can get as well, that price might be different. And so in times of crises, small print matters. And as an investor, you need to worry about what you have. And sure, I much prefer the physical gold over quote unquote paper gold. But everybody needs to, if they think they can get a good deal, getting something that's too good to be true, then good for them.
So, Axel, are you on all sides of the trade then?
We don't deal in gold derivatives. If that, so no, we're not on that side. But we're on the gold mining side and on the physical gold side.
Excellent. Excellent. Before I jump over to Tyson, I just want to round out our conversation. And that is, you're not 100% in gold. You have other assets. You want to talk a little bit about your other holdings and things that you like currently? Things that you think will produce alpha?
Well, sure. On the personal side, last year we bought several hundred acres of forest, for example. That's a long-term investment. And we historically have done real estate. We do some farming. We have a vineyard, but that is, I think that's a negative alpha generator. That's good for mental health more than for profit generation. You gotta do that. You gotta do that too. And then, of course, I do have some traditional securities as well. And that is noteworthy because in 2007, I sold all my traditional equities. I haven't done that, but I have not allocated any additional money to any of that in the last 2 years or so. Indeed, the other day I tried to check my retirement accounts to get rid of anything in the S&P 500. Turns out I didn't have anything in there. So.
Well, that's terrific.
We have more questions here on gold. So Gary Saka.
Okay, so Axel, as opposed to you not giving advice, I'm going to give a piece of advice, and as don't hang around anyone carrying a pager. But I heard a couple of I've held gold for a long time, but unfortunately I trade in and out of it, so I don't make as much money if I'd held it. But so Elon Musk, they talk about him going to Mars, and they said actually the better investment would be to do Bitcoin, because to carry gold to Mars would be too heavy. So what about, I don't know if you've covered that, gold versus Bitcoin. I mean, I'm sort of a gold guy. Maybe I'm just too old to invest in Bitcoin.
I want to monopolize your entire session. So let's just say the risk profile is different, and the current environment, I think, shows that. I think there's a lot of value in the technology, and I think that especially should we get a change in administration, new technologies will be developed in that space. But the risk profile is quite different, and so and when push comes to shove, it's a little different type of investor, I think.
Hey, Axel, my only question was, what do you think about some of these, gold mining stocks, or what are good markets for gold mining? I mean, I think that Julian was saying, getting in at $1,800 for gold in the ground might be a good strategy. Any thoughts on that?
Well, we have a $450 million closed-end fund that we manage in precisely that space. And all I can say is that it is a market where you want to know what you're doing. And there are many risks that come with it. There are amazing opportunities that come with it. What we do is, as you would do in most other areas, we invest in management teams. It's more important to have a management team than, I mean, obviously there needs to be gold in the ground, but executing things. Topics like ESG were somewhat invented in that space long before they even knew the term. You cannot develop a mine unless you work with all the stakeholders, the local community where you're going to develop the mine, the government, and obviously the workers as well. And so there are some teams that have shown that they can execute. And so if you invest in that space, that is what you want to do. And then, of course, yes, then there's a decision to make, where do you want to be in the value chain and whatnot. But it's just like in any other space. It's the same management teams that can attract typically money for new investments. We have in our fund given money to a management team before they even identified a mine, because we said we trust you to find something, right? And so it's much more important than the fancy presentations of how much gold there might be. It is that people can execute. Developing a mine takes many, many years, and then the mine life tends to be short on top of that. So it's a fascinating area, but it's an area where you really want to. And then just to round that out, on the senior space, on the big companies, these companies overinvested in the last bull market, and then we're told they need to get their act together. And so that means they focus on cash flow, which actually gives them less leverage to the price of gold. And they're now so big that for them, it's not of any interest to buy these small gold miners. And so they tend to be acquiring these big copper gold projects. And that's fine, but it's a very different dynamic than these junior mining companies where you can get some tremendous leverage to the price of gold.
Fantastic. Thank you, Axel, for that. I have to move this on to Tyson now. So Tyson, why don't you talk to us a little bit about, I know you're also very bold on gold. You're very bullish on gold. But it's not the only piece of bread in your bread basket. So why don't you talk to us about how you're looking at the market and what you're focusing on, and what you're recommending to the people. And again, we're not making any recommendations up here per se, but we're talking in an educational forum here.
Thank you, Mark. Quickly, the Fed cut by a half, so our talk about gold, I think, is getting some momentum. They must have listened to Julian Bridgeton. I'd like to share a couple slides because a picture is worth 1,000 words. Can people see that?
Yes, we can.
The Great Rotation.
Can you put it on slideshow?
Yes, I'm trying. You see that?
Yep.
Okay, so the Great Rotation, life after the bond bubble. I think there are two thoughts here. One is the bond bubble, and the other is the Great Rotation. That's where alpha is going to be found. What I think is really important in terms of understanding making money in alpha generation is over the last 40 years, since 1981, the 10-year U.S. Treasury declined from 15.85% to 0.5% by July of 2020. And anybody who understands the fundamentals of security analysis, stocks, bonds, and real estate, when interest rates decline, that makes those assets go up in price. So for 40 years, 4 decades, most of our entire lives, we have enjoyed a wind at our back with declining interest rates. What's happened since 2020 is inflation went up to 9%, interest rates have moved up, and now the wind at our back is no longer the wind at our back. In fact, I would venture to say that we're in a bubble in stocks, bonds, and real estate, and for that reason, we are seeing a rotation. Another way to think about where valuation is in terms of the stock market in general is what is known as the Fed model, or the risk premium model. And what it does is it compares the earnings yield of the S&P 500 to the 10-year U.S. Treasury. And this has worked very effectively. In 2000, it said we were very overvalued and you needed to get out of stocks, and that was at the top of the tech bubble. And it told you to get in 2009, and then again during the European debt crisis, and then again during March of 2000. And so this works very effectively. What's interesting, and I'm going to talk about, is recently the risk premium has moved up, suggesting stocks are looking more attractive, and the S&P has moved up. But it's a slippery slope. So basically, the way a risk premium is calculated is taking the earnings yield, the inverse of the S&P 500, which if it's at 20, would be a 5 yield, and then comparing that to the 10-year U.S. Treasury. This summer, the economy was doing well, and the 10-year Treasury had a 4 handle on it. And the risk premium was almost at 0, which said it was getting close to really very expensive, not valuations not seen since the tech bubble. And then as inflation seemed to ease off, the risk premium improved. It went from 0.17 to 1.13. That's not significant, but I'm just saying it was less bad. But what really is important is that earnings in terms of the S&P 500 have flattened. Stock market has gone up, not because earnings are improving, but because the competition has become weaker. That's not a great win. And if we have an economic slowdown, earnings are going to slow down. Julian said it, and I'm actually quoting him here. Recessions typically have a 30% decline in the stock market. Now, I have something personal, some personal experience that I feel is very relevant to this whole great rotation concept. And what that is I ran a tech hedge fund and it did very well. And in 2000, it started up in November of 1999. And in 5 months, this was it. It was called Helsinki Advisors. I was up 112% in 5 months. I was using derivatives and all in tech. And I had a lot of tech clients and it was great. I was making more money than I could imagine. And I actually got out at the top and I can establish that. But over the course of the next 18 months, I slowly got drawn back into tech stocks. And with the benefit of hindsight, what I realized over the next 8 to 11 years, had I moved into small caps, value stocks, emerging markets, international markets, and commodities, I would have done great. In fact, commodities during that period from 2000 to 2011 or 2007 were up 10x. And that is where I think we are in the gold cycle. So another example of talking about the
Tyson, hold on a second, Tyson. We have a question.
Okay, go ahead.
Yeah, Tyson, one of the questions I had for you is, do you think though that the reason why, say, small caps, emerging markets, commodities did so well in that period of time, is it because that you had the emerging markets really growing? Because that's when they were really growing. And I'm just wondering their consumption of, commodities, but also I just think some of the wealth transfer that was happening in those economies made the middle and lower class there just consume a lot more. And I'm just wondering, are we still in that position today, especially in light of where China's economy is? So that's just a question that I have for you as to, I vividly remember, going down to Latin America and frankly launching an emerging market global PE fund. And it was at the height, 2009 to 2011, 12. And so I'm just wondering, do you still have those underlying macro drivers in the international markets?
A lot of people will say the China card has been played.
Yeah, because China was really driving it. I mean, India's, let's see, but right. So that is question.
Can I have your name and get back to you offline? That's a very complicated question, but it's valid. But my bottom line is, what I'm suggesting is there is great value now in the small cap value commodity area and international and emerging market. And that's where you should be going and getting away from the mega caps. And right now, I think that Argentina has recently taken off. And at the end of this presentation, I'll explain why I like China. So if I may, I'd like to continue.
Keep on going.
So yep. Outside of there being a great rotation, which is shown nicely here by Ari Wald, who's a technician over at OPCO, you're now starting to see that the cap weight indices are starting to lose their momentum and the equal weighted are starting to outperform. I think that is consistent with this rotation away from these cap weighted indices. And I'm sorry, I wanted to talk about NVIDIA because I think that NVIDIA and artificial intelligence are in basically a state of irrational exuberance. Everybody has gotten in. Everything Julian was saying, Bridgeton was saying previously, I completely agree with. And if you look at NVIDIA, the stock went up 11-fold in 22 months, and everybody's in it now at $3.35 billion in June. I think that was its peak. It will do well, but the multiple is going to collapse. They're going to get competition, and I think you have to move away from it. And as people move away from it, I think it'll drag the other Mag 5, Mag 7 stocks, NASDAQ 100, and ultimately the S&P. But what is working? This is where our friend Axel Merk is specializing, but what you are seeing is that gold is now starting to perform. It's breaking out. It's going to a new high. And I think gold miners as well. And what's important to remember, I think I showed somewhere, is actually during that 2000 to 2011 period, gold went up 10x. Oil went up about 10x. So that's where I would be looking to allocate. Julian was talking about it. He had a whole lot of great charts. And I think that actually China is showing some extraordinary companies. BYD, the electric car maker, is growing 50% a year, and it's trading at about an 8 earnings multiple, and they have incredible product. But the bottom line is you want to buy, it's basically contrarian value purchases in the emerging markets. Maybe it's not China. I think that that's certainly worth a look. All these stocks look like they're bottoming. I think the dollar is starting to top out, and I think that that's driving it. And so this is me. And if Jensen Wang is in the audience, he can give Axel, Merk $1 billion, myself $1 billion, and Julian, and we will help him hold on to his well-earned fortune.
Nice ending there, Tyson. But quick question for you.
I have a question also, Mark. Why don't you go first and I'll follow up?
Okay, so you touched on de-dollarization at the end. So when you're looking at the world today, are you thinking, assets in the East versus assets in the West? And this follows on to our conversation from last week, Marty.
I'd like to give an answer to that. The driver for gold is that actually de-dollarization, the de facto currency for that is gold.
Got it. But when you're looking at the assets that you're recommending people invest in, when you're doing and I know in the past you've done your 25, 25, 25. It sounds like maybe you've altered that a little bit. I'm not quite sure.
No, I wanted to keep my presentation short.
Now that's fair enough. But I guess as you think about it, are you recommending people to diversify away from the West and into the East? Or you?
Absolutely. I think the
Okay.
S&P is massively overvalued. Mr. Merk here just said he has no S&P exposure as of a month ago. I think that that's the right call. And I actually think that being in cash is not a bad place to be. So 25% in cash, 2-year treasuries, if you're getting close to a 5% yield, I think that that makes sense. And I think 60% in equities is crazy, 40% in bonds. A 360 yield for a 10-year treasury, that's not worth the duration risk given where inflation is.
Okay, Marty, you want to guess your question?
Yeah, I guess my China story. I mean, I'm still finding it hard to believe about China with the problems they're having in the real estate market, but I just think that this global bifurcation continues, and I think there was an article about Walmart trying to evade certain taxes as a result of what Temu is doing, right? And Amazon is trying to do the same strategy, and the government is kind of stopping that. I still think there's going to be like a great bifurcation one way or the other, with China on one side and the U.S. on the other side, and there'll be Chinese champions and U.S. champions, right? So,
well, I think of it more in BRICS, right, than just China.
That's my China argument. I don't know what you think about that, Tyson.
We'll see. I think that the argument against it is that China is a big controlled economy to some degree, and they have a lot of ability to influence things, and there's still a lot of people there. But I think right now there are some tremendous companies that are terribly cheap. Nobody likes it. You want to buy things that nobody likes and are terribly cheap, especially when they're able to generate good growth. And that's what I showed in some of the names that I held up under China.
Before I jump over to Sid, I want to hit you with one more, Tyson. How do you think of privates versus public assets in people's portfolios right now, to the extent they're still on the Western side of things?
It depends where you're going to come public. But I mean, I think right now I wouldn't want to be in privates because I think that the equity markets are not going to make it easy to go public and find some liquidity. And I think those valuations tend to track the U.S. public market, so they're expensive, but your ability to get liquid is going to shrink. So if I had a lot in private equity, I would probably be looking to find exits if I could, if I were
Excellent. Marty, any more questions from the room for Tyson?
Nope. Let's continue.
All right, Sid, we're over to you. Real estate. So let's talk about real estate a little bit, if you would. just give us your basic, how you view the real estate market right now. I mean, it's a big, wide open, many sectors within that sector. Where are you bullish? Where are you not so bullish? What do you think plays right now? What are you staying away from?
Well, real estate markets continue to improve, especially with the Fed rate cuts that are coming. I think I heard one of the presenters say the rate cut today was 50 basis points. So that's definitely going to improve the cap rates on the properties going forward. May offer some relief to the office markets, which are depressed nationwide. Especially in metropolitan markets, there's a 30 to 40% vacancy in office buildings. Office buildings actually might be a good buy if you're looking to convert them into apartments, especially because of their locations, downtown areas. But the evergreen properties and real estate have always been the Class A multifamily in growing metropolitan markets with good economies, new employers coming in. A lot of metro areas have been getting these huge Amazon distribution centers, followed by FedEx, UPS. So they're good, compelling investments. The other properties tend to be the medical office space. They were still open during the pandemic. People had to go see their doctors, get surgeries done. And then grocery was another bright spot. Then you have the essential retail. These were stores that were still open during the 100-year Black Swan event. There are stores like Walgreens, CVS, Trader Joe's, Walmart's, Costco's, all those types of stores, Dollar Generals, they were open. So those are recession-proof, recession-resilient assets. And then, of course, you have the senior housing facilities. Storage has been a very bright spot. People literally store and forget it. Once they're in, they're there for 30 years. And then senior housing and acute care. I mean, people go in there and then basically come out on a stretcher. So you have literally a very long-term source of income. And the best part of real estate in general is the tax advantaged part of it, in which you basically get the income 90 to 100% tax sheltered due to depreciation and write-offs. And then the rest of the capital gains can be tax sheltered again via 1031 exchanges. So as long as you swap till you drop, you never pay a dime on your real estate holdings, and you get consistent income tax sheltered all through your life, in the range of 5 to 6% tax sheltered on an after-tax basis. It can be equal to 8 to 10% depending on your tax bracket. And then with capital appreciation, the annualized returns can be anywhere between 12 to 15%. So I view real estate as a get rich slow scheme versus the get rich fast dreams of stock investors. And your income continues to come, whether you're on a ship in the middle of the ocean somewhere in Greece or you're in Rome, but your income is still there. So you can enjoy your retirement and you can enjoy your life without really having to worry about your portfolio on a day-to-day basis.
Now, as you look at the markets, talk a little bit about a geography with me. Are there certain geographical locations you like better than others?
Yes. So we like California, but in California, with the real estate prices being very high, it's very hard to realize any sort of current income But from a capital appreciation perspective, California has always been a very good state. But it's really for very, very aggressive, bullish investors on real estate. But the Sun Belt states, you know, you have Arizona, Nevada, Texas, Washington, and also, you know, the Carolinas are really very good. New York City, you know, that's also been traditionally very good. But the tax-free states tend to generate most of the attractive returns simply because there are no estate taxes, like Nevada, Florida, Texas, state of Washington, Wyoming. So these are some of the areas that are DST sponsored, Delaware Statutory Trust. These are offered under federal securities laws, and we are securities licensed. So the investors get a higher level of due diligence versus what they would get from their real estate broker. It can make for a very good asset allocation, so to speak, in terms of alternative assets in your portfolio. And we recommend no more than 20 to 30% of a portfolio because these are illiquid assets. So even though it's real estate, it's a hard asset. It's recession resilient. We still classify real estate investments as speculative simply because your money is tied up for at least 8 to 10 years before these properties go full cycle through the cycle of acquisition, through operation, through disposition. So investors need to be cognizant of that. These are not fix and flip type of properties. These are institutional quality Class A properties in the range of $50 to $100 million each. On any given day, we have portfolio of $2 to $4 billion of properties ready to go, and investors can acquire them in as little as 5 business days, which is huge because if they have money sitting on the sidelines and earning 5%, somebody with a $10 million portfolio at 5% generates $500,000 a year. And with a real estate broker, if they have to wait 45 days to identify, 135 days to close, 180 days, they can lose almost $250,000 in income and cash flow, versus with us in the DSC property world, when they do a 1031 exchange, we can accomplish that in as little as 5 business days, because these properties, the Delaware Statutory Trust properties, come prepackaged with financing, with property management, and the financing is non-recourse. When other real estate investors, standalone properties, were getting rates in the range of 6 to 8%, our DST sponsors were still getting financing in the range of 4 to 5%, 10-year interest only. And interest only tends to give the most cash back to the investor because there's no reason to pay down the principal.
That's fantastic.
Yeah.
Thank you very much for that, Sid.
Mark, I just have a couple of questions for Sid.
Sure.
Sid, I mean, do you have any? So a couple of things. My first thing is, you know, there's this tremendous disparity in, at least for single family homes, in prices versus income in many cities in the United States. Like, for example, Miami, I think the average house costs $1 million now, and I think the average income is around the median income is $38,000 for a head of household, and maybe it's $60,000 per household. So, you know, there seems to be this chasm that's growing. That might be part of what Julian was talking about from an inflation, you know, point of view, or overinflated or bubble point of view. And then secondly, when it comes to, you know, office, it seems like a location really matters a lot, since, you know, we're in this office recession. And I think that, you know, predictions for things like New York City, you know, office buildings, which aren't able to be, you know, they're ultimately going to be tear downs because only about 5% are convertible to multifamily. You know, that's kind of a tricky place to be entering into. Any thoughts on those negatives?
Yeah, so in the Delaware Statutory Trust property world, we have stayed away from the acquisitions of single-family homes or putting together portfolios of single-family homes because of the inherent risks. And with the single-family homes, one tenant leaves in a single-family home, you have 100% vacancy versus one tenant leaves in a 400-unit apartment building, the percentage is infinitesimally small. So the income still continues. So our focus is on institutional quality Class A multifamily properties with 300 to 400 units across the United States in major metropolitan centers, major employment centers. So that's number one. And of course, we have also stayed away from acquiring any office properties in the last 7-8 years. So we didn't really have any assets or any exposure for our clients in the office buildings, and we're still not acquiring any office properties except the medical office. And they generally tend to be, not really 50 stories high. They're usually 2 to maybe 5 stories high buildings, closer to the regular hospitals. So that's a different ball game completely.
And Sid, are these mostly rental multifamily, or are they condominiums, co-ops? What are they?
Yeah, so these are rental multifamily apartments, not condominiums, but we do have senior housing. We have acute care facilities. And we also have student housing. Now, student housing was actually affected during the pandemic because the schools mandated that the students return to their homes. So the first year of the pandemic, since the parents had signed the co-signed the lease on behalf of their student, they had to pay the full lease. But in the second year of vacancy, that did cause issues for the sponsors, but now it's back. It's typically recession-proof, recession-resilient. And in the DST property world, the good thing is that the financing has to be fixed on day one. So that eliminates the economic risk, the interest rate risk, in the event the rates start to rise. And of course, when the rates start to go down, the cap rates start to improve, and we can sell the properties for a higher profit simply because the debt service cost is lower. So it really all depends on the debt service costs when you're acquiring these properties. And look, these properties were acquired when the syndicated properties have been around for a very, very long time. But the tenant in common type of ownership started in 2002 under IRS Revenue Procedure 2002-22. But that structure did not prove to be a very good structure because 35 co-investors had to vote on the refinance, releasing, sale decisions, purchase decisions. So in the 2007-2008 economic crisis, those properties went south. And then the DST structure kind of came into vogue under the IRS revenue ruling 2004-86. And that sort of created a very stable ownership structure and the lowering of investment minimums to $100,000 per investor. But if you have investors looking to invest 20, 30 million, $1 billion, we can definitely diversify them into 20, 30 properties and accomplish the entire portfolio diversification within 5 to 6 business days, which is huge.
Do you
for
think
their
this 50 basis point cut impacts, real estate by a sizable manner, or what's your perspective towards the interest rate cut?
Oh, it's beautiful. I mean, when the interest rate cuts happen, in fact, what it does is it does cap rate compression because there's a lot of money chasing these properties previously from investors who could not afford to get into these properties simply because the financing cost has now gone down. When the interest rates went up previously, the cap rates expanded because the investors demanded a higher income in order to service the higher debt. So
Do you think that there's a recession that people will be able to get some of these properties for heavy discounts, as in 2008 with the Great Recession?
Well, they were when the interest rates went up and properties that were on variable financing, 5-year fixed or 3-year fixed, literally in states like Texas, a lot of properties in Florida, they went into foreclosure. So a lot of these apartments, especially B, C, D class apartments, they were taken by the lenders and they were coming back on the market. But those are value add, and value add typically means that you have to pump in more monies. It's basically you're building sweat equity. So if the investor has patience and the ability to forego any income for the first 5-6 years of ownership, and then they're hoping then the property values go up, then they may make a good buy for those types of investors. But investors who are looking to get into institutional quality Class A properties, they sort of eliminate those risks. So even during COVID, when a lot of New York City and a lot of metropolitan area Class C, Class D properties were experiencing vacancies or tenants not being able to pay rents, the Class A properties were still getting 95 to 97% rents. So
yeah, I think that's a different timeline, though. I mean, the interest rates have really changed dramatically. So, Mark, Heil, do you have any other questions to ask your panel?
No, I think they did a fantastic job, Marty, and I really want to thank Sid, Axel, and Tyson for their presentations and insights into how to make some money in this current market that Julian laid out this morning. So thank you. Great job.
Great job. Thank you so much.
Thank you.